wish I could cut my answer.
Well, everybody is here, so let's try to do this again. See if it works this time. I really have no idea what it was this morning, so I guess there is a chance that this will not work again. But let's see. Okay, here we go. Try it again. It's still not working. Isn't this weird? I'm perplexed as to why this is not working. Oh well, shoot. Rose, you're our resident IT person. You have any ideas? Yeah, no. Yeah, no, the volume's up. I don't know. It's very weird. All right. Well, you know what? I might, because of this problem, I might just send this to you in your daily thing, and you can just watch it on your own. It's like a 3-minute video. It's very, basically, the president's trying to tell everyone to not get loose. Don't forget that we're still in the crisis. As Halloween is coming and block break is next week, I think it's just kind of a call to stay vigilant. So anyway, yeah. But I'll send this to you in the daily link and you can watch it. Yeah, maybe I'll figure out exactly why we can't play videos. But all right. So I want to spend just a little bit of time finishing up what we talked about this morning, right? Maybe we have half an hour or 40 minutes of new material to cover, and then we'll take a little bit of time to go over your exam, and then I probably have till about what time? Yeah, I have a little bit of time after class. I don't know exactly how much time I have, but I have a little bit of time after class. So if anybody wants to talk with me, we can talk outside, we can meet over Zoom, whatever. But we'll save that at the end of class. So this afternoon, I wanted to talk really two topics. One is to think about what are some of the alternative goals of monetary policy. What are some other things that monetary policy could be focused on? So I want to talk about three different kinds of alternatives here. So this is an alternative to what the Fed does already, which is what we talked about this morning, which is basically working the trade-off between output and inflation, right? Leaning against the wind and following countercyclical monetary policy, right? So there's some other thing that that a central bank could be doing. Well, certainly one goal is to be focused on preserving the stability of financial markets. Now, you can argue, and the Fed does argue, that this is not always something distinct from stabilizing output, right? So you can argue that in many cases, when it comes to preserving the financial stability of financial markets, that's also going to help preserve the stability of financial systems. However, right, the central bank could be focused on the stability of the interest rate, of the money supply, and of asset prices. And there have been economists that have argued that these would be appropriate goals for the Fed to follow. And in fact, at different points in time, the Fed has focused more on interest rate stability or money supply stability and maybe asset prices. So this is, let's talk about this one. I think this one in some sense is the most interesting. Should the Fed put as a goal stability in asset prices? Okay, so related to this, here's an example. Should the Fed try to prevent asset bubbles? Should this be something that the Fed should be focused on? So if the Fed sees a bubble growing, should the Fed take action to try to prevent it, right? So for instance, they see a bubble growing. Should the Fed raise interest rates? Right? For instance, should they raise interest rates and cut the money supply in an effort to prevent a bubble? Setting aside what's happening to inflation and output, should they just think about asset prices? Okay, that's a really interesting question. And actually, a lot of economists have argued both sides of this, right? Whether preventing asset bubbles is an appropriate role for the Federal Reserve. Let's think about the pros. In other words, the people that want the Fed to be involved in trying to manage an asset bubble. And the reason is, we know that when bubbles pop, it leads to a recession. So why can't we just prevent the bubble in the first place? And so a lot of economists have argued some variant of this, that asset bubbles in themselves are bad things. They create wealth and they destroy wealth and it impacts people's lives and it often leads to a recession. And so why don't we just put getting rid of asset bubbles as one of the things that the Fed should be doing? I will say though that the people who believe that are probably in a pretty strong minority, right? It's not that people who disagree with that believe that asset bubbles are a good thing. The question is this something the Fed can actually solve, right? And the cons really kind of fall into two categories. One is how does the Fed know when it's a bubble? Oftentimes, it's a bubble in hindsight, right? But if everybody knew it was a bubble, then people wouldn't be doing all the stupid things that they do when there's a bubble, right? So to put this another way, if we had people working at the Fed that knew when bubbles were happening, they wouldn't be working at the Fed, they'd be making billions of dollars running a hedge fund, right? So we shouldn't assume that somehow the Fed is smarter than everybody else. The Fed's got the same information many times that markets do. So if markets don't know there's a bubble, how's the Fed supposed to know there's a bubble, right? And I think that's a legitimate question, right? The Fed sometimes could be acting, thinking there's a bubble, and there's not, right? And so there's too much uncertainty related to this. That's what many economists argue. The second argument against this is the only way to pop a bubble is with a sledgehammer. And by that I mean, what's the Fed going to have to do to pop a bubble? Raise interest rates and cut the money supply. What's that likely to do to the rest of the economy? Slow it down, right? In other words, the Fed doesn't have a scalpel here. There's no way that they can reduce asset prices and not impact the rest of the economy. It's like performing surgery with a sledgehammer. All the Fed can do is they have these big policy tools, open market operations, right? That's going to impact a whole bunch of other stuff in the economy. And so on this one, economists really kind of go back and forth about how much financial stability should weigh in central bank decision making, right? And I just have to say there's just not really a lot of clarity on this, right? In many ways, I think the Fed worries about financial stability because they worry that it directly impacts output stability. But in other ways, they don't want to think about this too much, right? Because the Fed, as we say, they really only have these very rough tools, right? These very rough tools. There are other tools that the Fed can use, though. And that's being the lender of last resort. And very importantly, the primary regulator. And these tend to be the tools that the Fed does use. So setting aside monetary policy, these are kind of outside of monetary policy, but these are the things that the Fed tends to use to promote financial stability. Being a lender of last resort and regulating, right? Making sure that banks and other financial entities aren't doing crazy things, that they're keeping adequate reserves, they're keeping adequate bank capital. So, so there's one thing that central banks have to think about outside of the main two of output and inflation. Something else the central bank could think about as a goal is the stability of the exchange rate. As I'm going to explain tomorrow and Monday, we're going to talk about exchange rates. And I will explain that in many ways, the Fed will never say they don't care. But if you look at how the Fed reacts, they don't care about the dollar exchange rate. And why don't they care about it? Because they don't have to. The dollar is the international currency. It gives the dollar a preeminence in other countries' monetary policy. But as a result, the US kind of free rides on a lot of other countries managing their exchange rates. So the Fed doesn't really, this really plays almost no role in monetary policy in the US. But other central banks, this becomes the primary goal. Particularly for central banks that fix their exchange rate. As we're going to talk about, if you fix your exchange rate, you cannot think about these other things. Fixing your exchange rate really means you're adopting your exchange rate stability as your primary goal. And so we'll talk about why other central banks make this choice to make exchange rate management their primary goal. And we'll do that tomorrow, right? Or at least begin to do that tomorrow. And then finally, the third goal that the Fed could think about is to adopt an inflation rule. And by a rule, we mean a single goal. So this is actually a big debate in monetary economics. What are the benefits and costs of adopting a single rule, right? A single goal called a rule as opposed to balancing multiple goals. This is what the European Central Bank does. The only goal of the European Central Bank is to maintain 2% inflation. That's it. They are not charged with managing output. They're not charged with managing financial stability. They are not charged with managing exchange rates, right? They just have a single goal, right? So the proponents of rules lay out some benefits to them. One is obviously you're a lot more likely to achieve a single goal than you are to achieve many goals. Because we know that there's a trade-off between inflation and other goals. You're much less likely to make a mistake if you pick what's most important to you and focus on it. A timing consistency is the idea that you have to pre-commit to a single goal in order to achieve it. Okay, time inconsistency is a real problem in many sorts of policies, right? A classic example of where time inconsistency can get people in trouble is with hostage negotiations, right? So if, let's say that some country takes an American hostage, okay? What is the optimal policy for the United States in that situation? Do we negotiate with them or do we not negotiate? What's the best policy? You don't negotiate. And why don't you negotiate?
Because if they gain something like some kind of compensation in order to get that person,
Exactly. You're just incentivizing taking hostages, right? So the US government has set a rule, a law, that the US government is not allowed to negotiate with other people for American hostages. That is the law. Okay? Why the law? Because we realize we're much more likely to follow a realistic hostage policy if we have to obey a single rule and not think about anything else, but just obey a single rule. Having said that, what have a lot of administrations done? They've cheated. They cheat, right? They say, oh yeah, we're not going to negotiate. And then through third parties or behind the scenes, they negotiate, right? And so you're familiar with American history. You'll remember the Iran-Contra scandal, which was basically the Reagan administration negotiating with Iran for hostages behind the scenes and in violation of American law, right? So that's a problem, right? That's a problem. So time inconsistency is a real problem. How do you commit yourself to difficult policies? You just have a single goal and you really commit yourself, right? Some of you might remember from principles, I told this story about when I was a kid and I got 2 younger sisters. And so I think I was like about 8. And so that would have made my sisters 6 and 3. And we didn't take a lot of vacations, but we grew up in Ohio and we were going to drive down to Florida and go to Disneyland, okay? So my mom puts a bunch of, peanut butter and jelly and bread in the trunk because she's cheap. And the 3 of us get in the back seat and my mom usually did the driving. So she starts driving and we get out the driveway and we are not even out of the driveway. And me and my sister are just slapping the crap out of each other, just screaming and yelling and fighting. And this is the days before seatbelts. So I think we jammed my little sister up in the back window and, it's just chaos. And so my mom pulled the car over and she says, if you kids don't shut up, we're not going to Disneyland. Okay? She's telling us she is going to commit to the difficult rule of law and order, even if it means us not going to Disneyland. And so she gets right back on the car and starts driving, and what do we kids do? Sit there like little angels? No, we started fighting, right? We fought all the way down to Florida. Why? Exactly, right? We knew the mom had the back trunk packed with bread and peanut butter, and that there was no way that we were going home. It wasn't credible because we knew there were other goals that she was trying to achieve, right? So, if she would have stopped right there and turned back and we didn't go to Disneyland, we probably would have grown up to be better people, right? Because we would have listened. But we didn't do that, right? And we don't do that because we understand the incentives when you have many goals to not follow any of them, right? And so that's kind of a convoluted way of saying, how does the Fed really achieve long-term low inflation? By truly committing itself to that. And how do you really get a commitment to that? A rule, right? The other benefit of a rule, or is really related to this, is it's a way of creating credibility, right? It's a way of creating credibility. Right? It keeps expected inflation low. So those are actually some persuasive benefits. Those are some persuasive benefits. But like most other things in economics, there's some cost to this. And some of these costs are pretty obvious. What's the cost of having an inflation rule? What do you think? Jonah, what do you think?
You don't do anything else.
You don't do anything else, including things like output stability. And I think we talked about this when we talked about the European debt crisis. When the European Central Bank has its hands tied that the only thing they can respond to is inflation, it has really limited their ability to stabilize output or to promote financial stability. They can't act as a lender of last resort in the same way that the Fed can, because they don't have the flexibility. They don't have the independence, right? This is a limit on independence. Right? We talked about goal flexibility, or I'm sorry, goal independence. Yeah, goal independence, right? Versus instrument independence. The European Central Bank has almost no goal independence. And so that really limits what they can do, right? That really limits what they can do. Whenever I think about this, I always think about the old saying, there are no atheists in foxholes, right? And I don't know if you've ever heard that phrase before, but what does that mean? Well, it means, you know, you're an atheist, but when you're in a foxhole and the bombs are coming, your thought is, well, shoot, I might as well pray it can't hurt, right? And I think that's oftentimes how central banks feel. They love the idea of inflation targets in theory, but in practice, when the you-know-what hits the fan, oftentimes they feel like they wish they had some other alternative, right? And so, you know, this inability to stabilize output under inflation rules, this is the big cost, right? This is a big cost. The Fed does not have an inflation rule. The Fed has what they call a target of 2%. But it is not a rule. There's a lot more flexibility with this. And so there are economists out there who really believe that the Fed should move to an inflation rule, right? And this is something that gets talked about periodically. I have to say, and you know, I think this was something that looked better 10 or 12 years ago, right? Given all the financial instability of the last decade or so, you know, I just think that the lack of flexibility that a true rule gives you just doesn't look that appealing, right? It just doesn't look that appealing to many economists. And so that's not to say that there aren't, you know, we don't see some value in this, but there's a lot of value to not having a rule either and having some flexibility. Okay, I want to talk about one last thing here this afternoon, and that's what's called the Taylor rule. And this relates to the question of how do goals translate into targets? How do goals translate into targets? In other words, if we have a goal, then what's the appropriate target to get us to that goal? So let's say that our goals are this. Output is going to be a potential output. And inflation is going to be at 2%. Right? So we're going to call that pi bar. That's going to be our goal, our target. And instead of putting this at level of output, we're going to say this is the growth rate of potential output. So our growth rate, instead of expressing in terms of levels, we're going to express it in terms of the growth rate of output. So the Taylor rule is basically, an economist by the name of John Taylor said, you know, the Fed has some pretty explicit goals here. We could actually use a little bit of econometrics to figure out how exactly the federal funds rate should translate into, or how these goals should translate into a federal funds rate. So the Taylor rule says, here's our target federal funds rate. How would we figure this out? Well, one way you could think about this is think about this as the average federal funds rate plus actual inflation. But then adjust for the fact that sometimes actual inflation is off of your target. And also adjust for the fact that the growth rate of output is off of your target. Okay, this looks a little confusing, but I just actually want to say that this is really what we've talked about this morning. This is just really an algebraic way of talking about what we did this morning. What should the Fed set as their federal funds rate target? First off, it should be what actual inflation is, because actual inflation always figures into the interest rate. But then, what happens if actual inflation is greater than our target? Oops, there should be a bar here. Sorry. What happens if actual inflation is greater than target? What did we do to the federal funds rate? We increase it. Right? In other words, if inflation's higher than target, what should we be doing? Slowing the economy down. Slowing the economy down by raising interest rates. And what happens if the growth rate of output is greater than the growth rate, our long run growth rate? Once again, we slow the economy down by raising interest rates. What happens if growth is less than potential output? Then we cut interest rates, right? Then we cut interest rates. So Taylor says, let's assume that our growth rate of output, of potential output, is 2%, and the target inflation rate is 2%. We can actually use this equation to figure out what the targeted rate of interest should be that the federal funds rate of interest that the Fed targets. So Taylor got some data. Right, I will show you what he found here in a second. Shoot. Where is it? Okay. That wasn't good. What happened? What did I do? That was weird. Dropping the remote makes it turn on and off, okay? Anyway, so the red line is using the Taylor rule equation to determine what the federal funds rate target should be. And the blue line is looking at the actual federal funds rate target that the Fed picked. And what do you see? They look pretty much alike, right? In other words, it is almost as if the Fed follows this rule. It's almost as if the Fed follows this rule. Not perfectly, but this rule kind of explains pretty well what the Fed does. You notice, though, that there are a couple of times when this didn't happen. First off, notice here in the 70s, right? The Taylor rule said that interest rates, the Fed should have been raising interest rates a lot. And instead, what was the Fed doing? Keeping interest rates low, right? And so this was a time that the Fed didn't follow the Taylor rule and they got in trouble. Some other people point to, look what happened here, like in the 2000s. In general, once again, the Fed, it's actually a little hard to see in here, but because there's too much space, but if you look at this more closely, the Fed kept interest rates lower than what the Taylor rule would have suggested in most of the 2000s. And many people have said that was a mistake in policy because by keeping interest rates low, the Fed set the stage for the housing price fall, right? That the Fed made it too easy to borrow money in the early 2000s. They should have seen that a housing bubble was coming and they should have raised interest rates more. What's been true for almost this last decade, though? Almost this entire decade, the Fed has kept interest rates almost at zero. And the Taylor rule has said you should keep interest rates higher than that. And so it appears like the Fed recently has kind of abandoned the Taylor rule, right? And in part, I think it's because the Fed has put a lot more emphasis, if we switch back here. The Fed has put a lot more emphasis on output than inflation, right? So in other words, what I'm saying is, I think you could argue today that this Taylor rule, it might be something more like 3/4 and 1/4, right? That the Fed is telling us they're putting more emphasis on output stabilization. Why? Because that's the thing that's most out of whack, right? Inflation continues to be low, but output growth continues to be fairly out of whack. So the Taylor rule. Fed watchers pay very close attention to the Taylor rule. This is actually something that if you read The Economist magazine, you'll see references to the Taylor rule. And really all the Taylor rule, as I said, is just a numerical equation that tries to capture what we talked about graphically this morning, that the Fed balances a trade-off between inflation and output, right? And so, yeah, but how this trade-off gets balanced is really based on these weights. And as we talked about this morning, I think the Fed pretty clearly is saying, we're going to put more weight on output going forward, and we're going to put less weight on inflation, right? And that's just a reflection of the time that we're living in. So, yeah, there you go. That is, well, that's not everything you need to know about monetary policy, but that's a good chunk of it, right? So, yeah, we spent a lot of time talking about monetary policy, but as I said, it's really hard to understand financial markets and understand banks without having a good idea of what the Feds do. So tomorrow we're going to change gears a little bit. We're going to, really this is how the rest of the class will go, is that tomorrow and Monday we will talk about exchange rates, all right? And kind of the global financial system, global capital flows, global interest rates, that kind of stuff. So that will be what we talk about Monday and Tuesday. Or I'm sorry, tomorrow and Monday. And then on Tuesday, we're going to talk about the Chinese financial system as a way just kind of mix it up a little bit, compare and contrast to the US financial system, and then we'll take our final exam on Wednesday, right? So yeah, we're definitely headed to the home stretch here, right? Okay, let's talk about the exam very quickly. So as I said for the first exam, there will be a curve. on this second exam. Right now, I would say that the curve on this exam is something between 7 and 10 points. It's probably more towards 10 points as you go lower on the scale, and it's probably more like towards 7 points as you go higher on the scale. But that gives you some, if you want to kind of put, I don't officially curve this class until the end, right? So what goes into my grade book is just the number, right? I'm not giving you a letter grade on this. But if you want to put your grade, into some sort of number, yeah, it's between 7 and 10, maybe even a little bit more than 10 for grades down in the 60s and 50s. All right. So let's kind of talk through these. As I said, I'm going to try to do this pretty quickly. I'll focus more on questions where I thought there were bigger problems than other questions. Question number 1, all these definitions, once again, I thought this was a pretty big indicator of how you did on the rest of the exam, because most of these were just really straight out of your notes. Shadow banking is when non-bank institutions engage in banking behavior such as lending. Insolvency is when your assets are less than your liabilities. Financial derivative is a financial asset that is derived from another financial asset, such as a mortgage-backed security. And the Federal Open Market Committee is made up of the 7 Board of Governors, and then the New York Fed president and 4 of the 11 other presidents, and they are the committee in the Fed that is responsible for monetary policy. Okay, question number 2. I was disappointed with how we did on this question. There's still, I think, a lot of confusion about exactly what a bank's balance sheet looks like and how do you account for losses and what exactly is bank capital, right? I think there's just a lot of confusion about what bank capital is, what it isn't. So we have this balance sheet. Right? And so okay, here's our balance sheet. So for the first part, we have deposit outflows of 25 million. So what happens? Oh, I'm sorry, that should be 300, not 275. So what happens if we have outflows of 25 million? That becomes 275, and that becomes 25. Okay. What's this bank's excess reserves? Excess reserves are total reserves minus required reserves. What are required reserves? 10% of 275. What are total reserves? 25 million. For a difference of 2.5 million. That's how much this bank is short. So what should they do? They could get a loan from another bank in the federal funds market. They could get a loan from the Fed. They could sell their treasury securities. They could maybe sell loans. That's unlikely, but maybe they could sell loans. So those are 4 options, right? You needed to talk about 3 of those 4 options and mention that they don't have to replace all that money, right? If they have an outflow of 25 million, they have some excess reserves, but they need to make sure that they don't have negative excess reserves because that means they don't have enough required reserves. Okay, now go back to the original balance sheet. Now the bank loses $25 million in their loan portfolio. How do we account for that? Well, now loans go down to 395. where there's a lot of confusion is how it's got to impact this side of the balance sheet too, right? It doesn't just impact assets. This all comes from your capital. Loan losses have to come out of your capital. So what was leverage before? It was the amount of assets, which is 700 divided by 50 or 14. What's leverage after? 675 divided by 25 or 27. So leverage has skyrocketed because this bank is a lot more risky. A lot more risky. If this bank has a capital requirement of 8%, what must this bank do? Well, they have $675 million in loans. They have to hold 8% of that as capital. They have to be holding $56 million of capital. How much capital are they actually holding? 25. So what are they going to have to do? They're either going to have to do one of two things. Either they're going to have to raise $20 million in capital. How likely is that? Pretty unlikely, right? When you just lost 25 million, it's not going to be very easy to go out and raise another 21 million. So there's only two ways you can reduce leverage. You either have to raise your capital or you have to lower your assets. Right? So think about this. Assets to capital, our capital is 25 million, our assets is what we're going to try to solve for. Oops, I'm sorry. So let's do it this way. So our capital to assets ratio has to be 0.08. If our capital is 25, then we can solve what our assets are. Right? We have to cut our assets all the way down to 312 million. So think about how big a change this is. We're at 675. We basically have to cut our assets in half, more than half, right? And so what does this mean about a financial crisis? Well, I think this illustrates it. If a bank takes big losses, they either have to raise capital, which is very difficult, or they have to absolutely stop lending and call in all their loans. In other words, they have to stop being a bank. And that's how financial crises operate, right? Is that during a crisis, nobody lends to anybody else, and that just feeds on itself. So, right, these kind of accounting ideas, I mean, they might seem technical to you, but they're absolutely fundamental to understanding how banks operate, right? Absolutely fundamental. And so, yeah, I think there's just a lot of confusion about what is bank capital. I think, a few of you said, well, if the bank takes these losses, what they can do is they can just go borrow more money. Borrowing more money is not going to reduce your leverage. Because what happens if I borrow some more money? Well, if I get 450 here, and now I'm holding $150 of reserves. That makes me more liquid, but it doesn't reduce my leverage, right? It makes me more liquid, but it doesn't reduce my leverage. And so that's the problem, right? That's the problem. Okay, question 3. In general, we didn't have any problems with this, so I'm just going to kind of skim over it. Same with question 4. I think these are questions that are right out of your notes. Chapter 5, what's happened to the risk-return trade-off of U.S. commercial banks? It's gone up, both the risk and the return. Discuss 2 financial innovations. We've talked about a lot of them, whether it's shadow banking, whether it's securitization, whether it's financial derivatives, whether it's market trading, whether it's digital payment systems. And we talked about a whole lot of different innovations. in chapter 9 and chapter 10. And so you just needed to kind of talk about two of those. What's the net transfer equation? Right, and so when do you get a positive source of funds from your debt? When G is greater than R. But what happens during a crisis? A crisis, G goes down and R goes up. And so this becomes true. And now you're hemorrhaging money, and markets see that and they don't lend you anymore. At what debt level are debt crises triggered? There is no level, right? And this has to do with debt tolerance. It's much more about the history and the confidence that markets have that you're going to repay your money. Question number 7. Once again, I'm just going to refer you to your notes on this one. We talked about Dodd-Frank. We talked about many different reforms. You just needed to talk about 3 of them and connect it to the 2008 crisis. Okay, question number 8. So this is a money multiplier question. So you could do this a couple of different ways, and some of you did do this some different ways, but the way that I did it is I just used the formula that we derived. This formula, right? But you need to first figure out what is little c and little r and little er. Little c is big C divided by D. C is 1,500, D is 2,500. So that's 0.4. What's little er? It's capital ER divided by D, which is that. And so we can plug this into this. And what we get is that this is equal to 2.02. Okay, 2.02. And so how big is the multiplier? The multiplier is going to be 2 times, the change in the money supply is going to be 2 times what the monetary base is. Okay, so what's M1? M1 is C plus D, right? 4,000. What's the monetary base? 4,000 divided by 2.02, or about 2,000, roughly. If the Fed conducts $100 million in open market purchases, what happens to the monetary base? It goes up by 100 million. What happens to the money supply? It goes up by 200 million because of the multiplier. How would your answer change if the Fed conducted 100 million open market purchase, but depositors pulled 50 million out? Then only 50 million would be multiplied. So in that case, the monetary base would go up by, still go up by 100, but the money supply would only go up by 2 times the amount of the change in reserves. So it would only go by 100. Right? It would only go by 100. 2 times 50 million. Okay, and then finally, our essay. Once again, when reading this essay, I do think for some of these questions, there's better answers and worse answers, but I was definitely open to multiple answers. One of the things, though, that I was definitely looking for, and I think I mentioned this in the first essay that you did, is looking for times when you contradict yourself, right? Because that's easy to do in these, where you say one thing, and before you know it, you're kind of contradicting yourself. And so, that did happen a couple of times, and I'll kind of talk about when that was most likely to happen to us. First off, do you think this is a belief-based or fundamentals-based? Well, it could be either, right? But definitely fundamentals have some role to do with this. In the article, they say that what percentage of the economy, right? 45% of its economy is tied up in natural gas and oil. So what's the chances that if the oil industry goes bust, that their banks don't take big losses? They're going to take losses, right? And so this is clearly a fundamentals-based crisis. Though I don't think you could rule out psychology either, right? Because once people get fearful, that starts to play a role too. How should the central bank respond to this crisis? Well, typically, what do? You increase the monetary base and you increase the money supply. That might be hard though, because what's likely happening to the money multiplier? It's probably shrinking because people are getting scared. They're pulling their money out of the financial system. And so my guess is the central bank wants to raise the money supply, but can they do it given the financial panic? What should the central bank be doing to interest rates? Well, you can make an argument that they should be cutting them, right? But there's a cost to that. And I want you to kind of recognize this. If you cut interest rates, what's going to happen to some of that foreign capital that's in your country? It's taking off, right? And so that's kind of the catch-22 that a lot of banks get into, is they'd love to cut interest rates to try to stabilize their economy, but by cutting interest rates, they might encourage capital flight, which just makes things worse, right? And so that is a real catch-22 for banks, and almost certainly that's the catch-22 that Azerbaijan is in. How could this contribute to a sovereign debt crisis? Well, if these banks that are under administration really do go under, they're going to end up getting bailed out by the government, and that's going to drive up the debt. Do you see any connection to the current U.S. situation? I think some of you did, some of you didn't. This was very much, subjective. To me, I don't really see that much difference for two reasons, or I don't see much similarity for two reasons. First off, the Fed has so many more tools at its disposal than small little Azerbaijan, right? So Azerbaijan is just trapped by the fact that they're small and they're so reliant on foreign capital that it's very hard for them to change interest rates in any significant way. But I think the biggest difference between Azerbaijan and the US is that half of our economy isn't in one sector, right? So we have a much more diversified economy that makes us much more protected. Even during COVID, right? We are much more protected than a little place like Azerbaijan is. Some of you might have been following what's been happening to Azerbaijan in the news. So this article is actually from April. Since April, Azerbaijan is essentially in a war, right? They're in a war with Armenia. And it's, in many senses, it's a proxy war where Turkey is fighting on the side of Azerbaijan and Russia is fighting on the side of Armenia. And it is one of the most significant wars since the wars in the Caucasus in the early 90s. So it's a very unfortunate situation, one that has been exacerbated by the banking crisis that's gone on in Azerbaijan. Because basically, I think in part to distract from the economic crisis, but also to try to help the economy, Azerbaijan has tried to basically take land back from Armenia that they think is theirs. And so it's led to an all-out war. So yeah, it's a very unfortunate situation that is directly tied to the banking situation. So, all right, so that's the second exam. Let me just say one thing about the third exam. The last exam is not cumulative. It's just going to be on the last third of the class, right? So it's going to be the same point total as the first two exams, same setup. There's probably a little bit less material on the third exam, so that's good, right? That's good. That's less to prepare for. But yeah, we'll have one more of these, okay? All right. So have a good evening. If you want to talk, like I said, I'm happy to kind of step outside and we can talk out there. Or if you just want to send me an email, I'm also happy to talk with you on Zoom. I've got some open time now, basically till a little bit before 3. So if you just want to talk to me that way, just send me an email, okay? Okay, have a good evening.